Good afternoon, everybody, and welcome to our fourth class in our Successful Investing series. This class is entitled Verifying and Validating Your SSG Using Outside Sources, and it'll be presented by our good friend Cy Lynch. Cy lives in Atlanta. He's a member of the Better Investing Board of Directors, and on his spare time, he preaches on the weekends. Cy has a church in Atlanta, and Mark has told me that I have to reserve some time some Sunday morning to come in virtually and listen to our friend as he talks to his congregation. So Cy, it's all yours. I just have to get through the disclaimer here real quick. If you could click just once for me. We are going to be talking about real stocks in real time. Cy will try to tell you if he owns any of those stocks, but if he forgets, we're telling you that he might, okay? We're not making any recommendations to buy, sell, or hold. We are recording this particular presentation, and the recordings will be available on our YouTube site, probably starting tomorrow morning sometime. There are certain things that Cy might show you from different sources, and in fact, that's the kernel of the entire class today. So just because he's showing you these different places to use, he's not indicating that there's any kind of endorsement from Better Investing. With that, Cy, I'm going to let you take it away, and I'm going to sit back and relax here for the next 50 minutes.
All right. Thank you, Ken, and welcome everybody. And I'll just say one more thing about the sources that Ken kind of closed the disclaimer with. I believe the slides say, and I will try and point out too, when sources are free or subscription-based as well. There we go. So what we're going to be doing for the next 45 minutes or so. Hopefully there will be a little bit of time for some questions, perhaps at the end or certainly throughout. Just feel free to put them in the question box. We're going to start with a survey of manifest investing. For those of you who are subscribers or familiar with it, much of this will be review, but it at least brings you up to speed and catches up those who aren't familiar with manifest, and then perhaps there may be something I mentioned along the way that you're not familiar with. I certainly hope that as we get into the verification and validation process, that there may be some uses of manifest that you're not familiar with. Then we'll also be looking at Value Line, the Morningstar Premium Service, as well as Finance Yahoo. And again, many of you are probably familiar with Value Line, perhaps with Morningstar Premium as well, and we may have some ideas that maybe you've not seen before on how you can use those services. As I'd mentioned about the pay versus free sites, all of the sites that I just mentioned, except for Finance Yahoo, are pay subscription services. There is a basic Morningstar .com that is free, but the sorts of things I'll be talking about today on Morningstar are subscription based. Value Line, you can, if you happen to be looking at one of the Dow 30 industrial stocks, you can go to the Value Line site, valueline.com, and the reports are free there. Also, many libraries, school and public, have Value Line, and of course now in our digital age, that's often available online, as it is here in the county where I live, in DeKalb County, here in Georgia. Also, my school, Mercer, where I went to seminary, also has Value Line through their library. Morningstar Premium's available through some brokers, also available through some libraries. Interestingly, my library does have Morningstar Premium online, but there is a premium report that's available that they do not have available. So just if there's something that you see today or that you've seen in other persons, just understand that there's actually a number of different variations of exactly what Morningstar offers depending on the source. So here's Manifest Investing. This is the homepage for Manifest as a subscriber. You can see some information down at the bottom on cost potentials. And then along the top, you can see the research tab, which is company and fund reports. Then there is screening, and then there's portfolio management. We'll spend most of our time in the company reports and a little bit in screening side, at least to just show you. And then at the very end, I will mention the portfolio management tools. And in fact, I think I even called there, you have 2 bonus slides, free after you paid your cost of admission today, which I think was also 0, but by that point in time, you will have spent 40 minutes or so with me. We'll have a couple of bonus comments that are slightly beyond the actual scope of what I just showed you. So if you click on research, here's the tab that comes up. Go ahead and click on companies. And here is an example of what comes up. Just for language or nomenclature, you'll notice it's called the Equity Analysis Guide, or sometimes referred to as EAGLE. So you can just be aware that's what it's called. As we're going to see in the next few slides, this is very similar information that we get from our stock selection guide with some additions, and it just looks different, but it actually ties very closely. It is the George Nicholson Better Investing Modern Investment Movement methodology, just a little bit different look on it. You see under the expected income statement, the first few lines there is what we call the preferred procedure. And it walks you right through the preferred procedure. And then beneath that is essentially sections 4 and 5 of the stock selection guide, getting to our valuation and return. That's what it's called using the online SSG. Here's tying it to the SSG. The preferred procedure, you see at the top is sales growth. I'll just go ahead and bounce back. Notice current sales, it shows, and then the sales growth forecast. So that's ties in right here, sales growth forecast. Then less expenses. In our SSG, we split expenses into pre-tax expenses or pre-tax profit margin, and then take out taxes separately. The manifest expected income statement or preferred procedure combines those 2 steps and uses a net income. But it's the same information. It's just that manifest combines it into 1 step. Then you divide by shares outstanding, and you come up with an earnings per share growth rate, which is, again, exactly what you have here on manifest. The only difference being noticed that the manifest earnings per share bottom line, if you will, is in actual dollars and cents. It does not show it as a percentage rate on that particular screen. And this particular screen shows only the growth rate, although the actual dollar figure is up above. Then moving down, as I mentioned, the next 4 lines on the Manifest Equity Analysis Guide is sections 4 and 5 of the Stock Selection Guide. You're taking the PE ratio, multiplying by your earnings per share to get a potential high price. And then you get a yield estimate down in section 5. That's also shown on the Manifest Equity Analysis Guide. And then you get a total return. The one thing that I will point out here, and it's really beyond the scope of what we're going to do today, unless we have some extra time and you want to walk through it in detail, but I will just point out for those of you who have not noticed before that there are 2 ways shown on your stock selection guide to calculate potential return. One is called using forecast high PE. That's straight off of section 4 up here, A, which is high PE times the earnings per share. That's the way that we've always done it. That's the way that I was taught at the very beginning. In fact, the other way of doing it, if you will, hadn't even been popularized or published anywhere when I first learned the SSG back in the mid 80s. And it's probably, whether you go back that far or have learned since, it's probably the way you learned it. The way Manifest calculates the projected annual return, or what Manifest calls par, is using this second alternative, which, as you could see labeled here, is using the forecast average PE. Now, you don't see that anywhere on your stock selection guide, whether you're using Toolkit or the online tools. However, the software calculates that for you using your high PE that you put in up here in 4A, as well as your low PE in 4BA. And that is how Manifest Investing calculates it. It also ties closer to the value line calculations. I personally prefer that calculation. The biggest potential drawback to it is that sometimes, for various reasons, we monkey around with this low PE up here. I'm not going to get into all the reasons why. I'll just say one word: frequently upside downside ratio. But there may be other reasons that you want to adjust the low price. What I encourage you to do, if you want to adjust your low price, you can simply do it by typing in right here where the green bar is. You can type in anything you want. Leave the PE. I mean, come up with a good estimate for your low PE and don't monkey with it, because that will then give you a valid average down at the bottom. I went on a little bit more than I planned to, but I thought that the idea of potentially using this average PE to project your return is a good one. And one of the advantages of it, besides the fact that it ties closer to Manifest, which allows you to use Manifest a little closer as a verification and validation device, it ties closer to Value Line, also allowing you perhaps to use Value Line a little bit better as a validation and verification source. But it also, remember, we're talking ranges in everything we project on the SSG. None of this is precise estimates. We're estimating, and usually even in our thought, or frequently in our express calculations, but often in our thought process, we are using ranges anyway. We know that we're not going to be right on point, and using the average PE gives us a little bit more flexibility in that regard. Here's Manifest Investing. As we work through Manifest slides, you'll see some colors used. For the par, or the projected annual return, if it's green, that means it's within the target range of 5 percentage points above the average projected return for all stocks in Manifest database, and less than 10% above it. If it's yellow, it simply is a cautionary flag saying that par is above 10 percentage points more than the projected return. Here is the, perhaps it's one of the two major unique aspects of Manifest Investing that you really don't find anywhere else. And we'll look briefly at both of them. This is the quantified quality. And the other one that we'll mention in a minute is the screening tool using a total return calculated the better investing way. But this takes what is basically our sections 1 and 2, or the graph of historical sales earnings per share on the front side of the stock selection guide. And there again, I was doing my best to try and talk computer language, but I slipped into front and back thinking of the paper forms. But then also section 2, or the pre-tax profit margin line. You're roughly using those items plus a financial strength indicator. That is an addition to our methodology. The stock selection guide doesn't expressly talk about financial strength or balance sheet type items anywhere except for that one little block that talks about percentage of capital that is debt, total debt to capital. Other than that, the stock selection guide doesn't mention balance sheet or financial strength items. The first item on manifest does mention that. Then you have earnings stability, which that's just the straightness of the earnings line. Earnings or industry sales growth rate, again, that is the comparison of the company's growth, which again, you've got the 10-year history on the stock selection guide, although this is a projection, not the historical, but your projected growth as compared to the projected average growth for the industry. And then same thing with the net profit, company's net profit compared to the industry's net profit. So it's a way of doing the quality checks that you're used to, but doing it in a quantified measure. And here is an old version of the margin. The only thing, the qualification is correct. The new numbers are different than was the case when I pulled this slide. Blue is excellent quality, which is actually the 80th percentile and above. Green is average quality. Then you have a neutral, which is around the 50 percentile range, and then red is poor. Again, I've walked you through in words the SSG connection. Now I'll do it visually. Here you could see sales growth. That's comparing the growth rate of 11% on this particular stock selection guide. You compare it to the industry. The earnings stability line is this, the blue line down at the bottom. Those of you who are familiar with Toolkit and the R squared for earnings, it's a similar calculation. It's the same concept. And it also ties with the value line earnings stability. If you're familiar with that rating, it's again the same sort of idea. And then you have the pre-tax profit margin down here on the evaluating management side. So we were in the back room before we let y'all all in, mentioned that this would be a good break point, and very honestly, I'd forgotten I'd put a slide here. So let's go ahead and take a break and see if there are any questions.
Cy, we're right up to date at the moment. Mark is currently explaining, and perhaps it would be a nice thing to explain to the entire audience what that penalty for quality meant on the manifest part of it.
Okay, I had that would have been a good thing for me to mention, and I'll go ahead and explain it, and hopefully I get it right. If not, you or Mark chime right in and fix me. But let's see if I can go back to that slide. Let's see. Whoops, I'm going the wrong way. Or am I? Whoops. Okay, what did I? Okay, I see. Somehow I did hit the wrong button. That's why the question slide, because I didn't think I had a question slide there. All right. Sorry about that, folks. There we go. All right. So I probably actually, this wasn't quite the break point, but it's still a good break point. The quality penalty is what they are talking about here, and that is given for companies that have less than 10 years of history in the manifest database, and it's 5 percentage points or 5 points really, it's not so much of a percentage, though, since it adds up to 100, I guess it's close to percentage points, but it's 5 points per year of missing data. And if those of you who know AbbVie, which is what this company is, AbbVie was a spinoff from Abbott Laboratories. And the spinoff was about 7 years ago. 10 years of data minus the 7 of actual history leaves you 3 years quality penalty. All right. That still was a good break point because that was essentially the stock analysis portion of Manifest. I did also in the overview, although we're not going to talk a whole lot in our later parts, I guess at this point coming close to the second half of our session today on verifying and validating. We won't talk about stock screening, but it is, again, a unique feature of Manifest in that it gives you the ability to screen based both on that quantified quality that I mentioned, but it's unique in any sort of screening device that I'm aware of allows us to screen based on a possible return calculated over a 5-year projection, the way we do it on the stock selection guide. I, at one point in time, tried to do something similar with the American Association of Individual Investors, AAII Stock Investor Pro product, if any of you are familiar with that. But that I had to write myself, and it really was not quite as controlled and as useful to me as the Manifest way of doing it is. So here's what I like to screen on, which is the projected return, the projected annual return, or PAR. I screen on quality, and usually I'll put in a growth forecast as well, although not always. But you can do that. And while I haven't circled it here, in between you see financial strength, and I also screen on that. But I wanted to show you the better investing, or the SSG tools. And I hit the wrong button again. Sorry about that, folks. And I know there's another way to get back, but since I don't recall where I was, I'll just do it the boring way. Sorry about that. Okay, here we go. Now let's see if I hit the right button. There we go. Here are some additional screening criteria you can use. I don't normally use these criteria for most of my screens, but some people do. And if you're familiar with the Investors Roundtable that we do around the last Tuesday of every month, with a couple of exceptions on that date, you'll occasionally see people use. Mark likes the Manifest Rank for some of his screens when he talks about screening. Hugh McManus likes the 52-week low for some of the way he screens. And lately I've used projected yield a little bit, but I really tend to use that more as an evaluation mode once I've done a screen. But those are all available screening criteria as well. Here's an example of how I normally do a quick screen. I look at what is the average return, or my PAR, projected for the Manifest database. It was 7.9 here. I think it was 6.9 when I checked it, because I thought about updating this slide. This slide's about 2 or 3 months old, but interestingly, it was exactly 1 percentage point different, so I just left it the same. I usually just round that down so that I get a little bit beneath the sweet spot, if you will. So 12.9, I usually just cut it off at 12. If it were 11.9, I'd probably do 11. Quality of 80, that's excellent quality. I almost always am looking for excellent quality. You might want to relax that a little bit at some point. Right now, I wouldn't tend to do that, given the market at record high levels by and large. And then financial strength, I also wanted 80 and above, which is an excellent financial strength. And here are the results that I got, as I said, about 2 months or so ago. And I normally, for the first sort, I click on the top areas. You could click on any of these and sort by that. I sort by par. Sometimes I will then sort by quality and look at the quality. But again, since I'm looking only at excellent quality companies, there's not really going to be a whole lot of difference quality-wise. Here's where I may look at yield and click on yield, and then same thing on growth. I frequently will look and see what are the high-growing companies. So now let's go ahead and shift, and I won't stop for questions unless something just came up, Mark or Ken, because now we're shifting from manifest overview into actually using manifest, value line, and Morningstar to verify and validate. Okay, let's jump into the preferred procedure. Although it's called preferred procedure, which implicitly says there are other procedures, which there are, Cy Lynch asked that you consider it the only procedure, or probably the 99.9999% method of calculating your earnings per share, because this gets you, I do a whole class on preferred procedure. In fact, I've done preferred procedure in as many as 3 hourly sessions. So it certainly is way beyond what we can do today. But suffice it to say that all of these judgments that you see before you, you are making those judgments anytime you project earnings per share on the stock selection guide. No matter whether you just throw a dart and pick a number, you plug in an analyst number, you do a preferred procedure, obviously you're going through them, or if you use the look at the trend line and come up with a projection, you're making implicit judgments on all of these factors. So my argument is the reason it should be preferred and actually should be exclusive is let's go ahead and do it explicitly. So that's what we're going to talk about. How can we do that and gain confidence in our projections using the outside sources? The methodology that I do, I open the preferred procedure calculation box that you just saw. I usually will go ahead and enter sales growth and pre-tax profit margin projections that I call tentative. I get them by observing the sales growth line, what's the historical trend, what is happening most recently, and then what do I know about the company? Is the company slowing its growth because it's getting bigger? Is the company erratic growth? So I want to be a little bit more conservative and slower because I don't really know. Is the economy or the industry or the company itself entering a recessionary type environment? All of those things, I just come up with a projected tentative rate, growth rate. I do the same thing with the pre-tax profit margin. Probably my default on pre-tax profit margin is the 5-year average if things are normal, or if things are changing with the company, especially if the profit margin is declining, then I may use for this tentative the latest year. But again, I'm stressing the words tentative. Then I project a tax rate. I'll use value lines projection unless it's strange. We'll talk about where value lines projection comes from. Same thing with shares outstanding. I observe the historical trend and consider value lines as well. Then I go in and I start looking at second opinions. And here is value line. You see, of course, on the left side of your screen, the full value line report. And then I've blown up the last 3 years, that be the last historical year, 2019, as well as the current fiscal year, 2020, next fiscal year, as well as Value Line's 3 to 5 year, or for our purposes, roughly a 4-year projection. And you see it starts with sales per share, which again, we don't use in our projections, but there's sometimes, particularly if you're evaluating a company that has had mergers or spinoffs, that line can be useful, but that's just the beginning of this particular chunk. The areas that we're going to be looking at is earnings per share, total sales, and then we'll be looking at net profit, income tax, and net profit margin. The one thing that I will mention before going any further is you do have this annual rates box on Value Line that contains both historical as well as 3 to 5 year projections. Don't use it for these purposes. You can get some useful information, especially for the history, but the problem with the 3 to 5 year is that Value Line actually calculates its 3 to 5 year, and unfortunately you can't quite see it here because I X'd it out, but it actually says from 17 to 19 forecast forward to 23 to 25. So in other words, Value Line actually starts its projection in history. So it's not a true projection. It includes some actual data in it. Here's where the tax rate that I just mentioned, that is kind of my default tax rate unless I know something else is going on or if the company gives me a different figure. I'm looking at the 3 to 5 year, the 23 to 25 currently projection. Down here, tax rate 13%. Notice that's a little bit higher than the current tax rates. And of course, again, remember we had in 2017 and 2018 a disruption to the tax rate universe, if you will, because of Congressional Tax Act. And that's kind of starting to even out, but that's still a little bit in question. So just understand this may be a little less stable than it's been historically. Then I also use Value Line as a source for projected diluted shares on the stock selection guide. This example, I'll go ahead and confess as a teacher, wasn't the greatest example in the world because notice AbbVie's common shares outstanding doesn't really change over time. It's very steady and Value Line's projected, but the point that I wanted to make is don't use this line. You say, gee, common shares outstanding, why not just use that? We are actually looking for what's called diluted shares outstanding, which is actual shares outstanding adjusted for stock options and potentially convertible securities being converted into shares. This line on Value Line is actually shares currently outstanding. Usually diluted shares is a little bit higher than shares outstanding. So the calculation is divide net profit by earnings per share, which here it's done over for you. The reason it's a bad teaching point, look at what the answer is. The same as the Value Line, but that's rare that happens. Then to confirm our earnings per share or verify our earnings per share projection, we can look at Finance Yahoo, Value Line, Morningstar, analyst premium reports help, and company guidance. Unfortunately, companies aren't giving as much goals or guidance as they used to, in my experience, at least for long-term guidance. They give much shorter-term guidance, but if you have a company that does say we're projecting 10% growth in sales over the next 5 years, super, or even 3 years, it gives you some level of verification that you can look at, but we're not going to look in detail at that today. Here is Yahoo Finance, which is kind of my go-to site for a quick overview of company and quick overview of historical information and analyst information. There are other sites that you may, Reuters has a site that you can use, MSN Money, Zacks. There are any number of them, but Finance Yahoo tends to be where I go. And what I just like to take a look at is, here's the revenue estimates for the current year and for the next year. And you could see what the analysts have said. And I tend to focus on the average estimate, but it also gives you the range, which again, in this case, you could see that the range is pretty close. Even though there's 15 analysts, they all have a very similar projected idea for AbbVie, the company here. Another thing that you want to look at with Finance Yahoo, or can look at, is look at the trend. See 90 days ago versus current. And really, this is a positive. You see that as we're getting closer to September 2020, when this slide was prepared, of course, we're actually a little past that now. You see that the analysts were becoming more optimistic about the company. And then you have next quarter and the current year and the next year estimates. And you could also see the revisions, how many were up or down. But let's say that it was $10 90 days ago and now down to $2.76. That would be a red flag. You'd want to try and find out, okay, what has happened to the company? That's really what this slide is for. It's kind of a validation or a looking for a red flag. If you see the trend is pretty steady or up a little bit, then it just says, hey, the analysts and everybody seem to be pretty confident right now that there's not a lot of uncertainty going on with the company. Then you can also use Value Line as a second opinion for your earnings per share and sales. And in fact, notice it tracks our stock selection guide very nicely. Again, since this is an online tool, it's going out. It is consistently moving out, but generally the last column on our stock SSG analysis is 4 years out or 5 years out from the last actual year for a 4-year projection, 4-year period projection. So you can take Value Line's 2020 projection for sales and earnings. Right here, it's earnings I'm pointing to from here, and put in for 20 and 21. And then also right out here at the end, you can plug in the 3 to 5 year or an average of 4-year projection so that you get an idea what Value Line's projecting. As you can see here, it looks like Value Line's a little more optimistic for the next couple of years than our long-term trend, but is right just about on line with our long-term trend on sales. Earnings per share, Value Line's a bit more ambitious or a little bit less conservative for this company. Then getting into the nitty-gritty. Remember, the first thing that we project on our preferred procedure is sales growth. And here is using Value Line to project sales growth. I give you the formula for all of you statistical geeks or financial calculator guys of the present value divided by future value raised to the 1/4 percentile, and that comes up with a number. If you use spreadsheets or financial calculators, you can plug that in. What I generally do is I encourage you to just go to Google, type in CAGR calculator, see what comes up. When I prepared this slide, this is what came up, a calculator at moneychip.com. And this is what it looks like. You just put the current fiscal year of 4580 in. Then you put the 3 to 5 year, which comes out, averages out to 4 years. Put that in as your future value. Say it's a 4-year projection, and it will do the calculation for you. Those of you who have heard me talk about financial calculators in the past, I used to always recommend one on Investopedia. Investopedia has changed, and they no longer, at least the last time I searched, did not have the calculator on there any longer. And that's why I have just gotten to just recommending that you just Google it and find one. Investopedia used to be the first one that came up when you did that, but like I say, they don't have the Investopedia calculator any longer. We can also use Value Line to do our next line on the preferred procedure. We first project sales, then we project pre-tax profit. Value Line doesn't give us a pre-tax profit margin, but it gives us a net profit margin. Those of you who used to do paper SSGs using Value Line probably remember how you calculated pre-tax profit, not margin, but the actual pre-tax profit to fill out your stock selection guide. This is the same formula. Net profit margin divided by 1 minus the tax rate, and be sure to express the tax rate as a decimal. Using the math here from Value Line, the pre-tax profit margin is, net profit margin is 32.8. The income tax is 13%, which is 0.13. So 1 minus 0.13. And then you see the rest of the calculation comes up with a pre-tax profit margin, according to Value Line, of 37.7%. Here is the PE, which again I use kind of as a potential PE projection. Now this can certainly, we may adjust our own projections, and I frequently do, but this is a comparison point. But the advantage of, notice that this is a average PE. So compare this to your high and your low PEs. Mentally do your calculation. If your high PE is 20, your low PE is 10, that means that your average PE is 15, which if it were this particular company, you'd be just a little above the Value Line projection, but not that much. And you might consider, if you don't really know where to put your PE projections because the company is rapidly changing, it's perhaps a recent spinoff, so it doesn't have a lot of information. Perhaps there's been a significant merger. Perhaps there's just been a lot of changes in the company, so your history is not as valid. Slowing growth rates are an example. You might just consider a rough idea of about 25% above Value Line, or around 15 it would be, because 25% is 3, so that'd be about 15, and about 25% lower, which in this case would be around 9 as your high and low PEs. Those are just, again, ways to use Value Line to compare to your stock selection guide judgments and to help validate and verify, increase your confidence in your projections. Then we can get at least the preferred procedure information. Morningstar is another source. Morningstar, back when I first started doing this sort of analysis, going on 15 years ago now, Morningstar was a reliable source of second opinion on sales growth over the next 5 years. It's not nearly as reliable any longer. And by reliable, I'm not talking about accuracy. I'm talking about that you even have it. Morningstar used to virtually always give you a 5-year estimate for revenue or sales growth. they're a little less consistent now, but it's still a potential source. So I encourage you to go there. If you're going to find it, you usually find it under their fair value discussion. And in this case, for bookings holding, they do say we are using a 9.7% revenue growth projection. So that gives you a comparison that you can use to compare the value line and to your own tentative projections. Morningstar most times still talks about something they call operating margin. Again, I'll just throw out a caution. Be careful to watch your definitions. Different sources use different definitions for terms like operating margin. The way Morningstar defines it actually is pretty close to our pre-tax profit margin, except for companies with significant debt. If there's not significant debt for the company, it's going to definitionally come real close to our pre-tax profit margin, but it's at least worth a check. And if you see a huge difference, you may want to dig deeper or just say, I'm guessing Morningstar is using, there's something that's different in operating margin for Morningstar versus pre-tax. But like I say, the difference is usually a significant debt load. But usually if you don't have a whole lot of debt for the company, Morningstar's operating margin is pretty close to our pre-tax profit margin. What is always good, however, and I usually do, is Morningstar will normally, as they do here, talk about we expect operating margins to expand to 41 from 37. So even if the 41 doesn't really track your pre-tax margin, you do know that Morningstar is projecting margins to increase. So if you're projecting margins to increase, then Morningstar is validating your projection. Or even if you're projecting them to stay roughly the same, you realize Morningstar is telling you that there's the potential for expansion, which should increase your confidence or validate your profit margin projection. Manifest investing, as I spent time on early on, tracks our pre-tax profit, our preferred procedure right in line. So these numbers track exactly. You can compare Manifest consensus analyst estimate for sales growth to your sales growth projection. The net profit margin you need to calculate if you're trying to track into a pre-tax margin, but that's easily done. Just multiply your pre-tax profit margin by your by 1 minus the tax rate, and that will give you basically do the reverse of what we did for the value line moving to pre-tax profit margin. Just multiply, if you're projecting 13% tax, just multiply your pre-tax margin by 0.87. That's 100 minus 0.13, and that will give you. Yes.
I'm going to interrupt. You have about 4 minutes to wrap this up.
All right. Thank you. Because I think this is my last slide except for the bonuses, and I'll just leave the bonus alone. So there's your net profit, your shares outstanding, and then your PE. So Manifest tracks right in line. You don't have to do any finagling other than the net profit. And then, as I mentioned, here's the bonus. Portfolio management. You can evaluate your portfolios. And I talked about portfolio-centered decision-making. And since we're roughly out of time, and Ken yanked on my coattails, plus I had kind of noticed that too and was going to stop. You've got the handouts down in the handout area. You can read my comments just as easily as I could have explained them to you, because they're just quick overviews. So we've got a couple of minutes left to catch any questions or to breathe.
Cy, one of the questions that we've been asked a couple of times is the source of the data for Manifest. Can you help us out, or maybe Mark would chime in and help us out?
All right. I'll give the quick answer, and then Mark can perhaps give a little bit more detail. But notice I just briefly called it analyst consensus. It's a conglomeration, takes a look at a number of sources from Value Line to S&P to Morningstar. And also, I'm sorry, I can't recall your initial historical data source right now, Mark, that you have switched to over the last few years, but that would be a source as well. So I think of it as my network. You know, a group of analysts that all come together and are in my investment club, and Value Line says one thing, says, oh, I think it's 15, and somebody else says, well, maybe 13's a little better, and so forth. And then you come up with manifest that ties that all together. You want to expand on that a little, Mark?
Yeah, just add a couple of the others to the mix. The analysts at S&P are part of it. You already mentioned Morningstar and Value Line. We lean on pretty heavily. The source of a lot of the data, which is updated virtually continuously, is from Y charts. They use a lot of Morningstar type data, but a lot of their stuff is also analyst consensus driven. So you'll see us publish that type of stuff. So again, just to capture it, an image, it's like locking all the analysts who cover a company like AbbVie in a room and saying, come up with a consensus stock selection guide. That's what we do.
We've gotten some questions about where you can find handouts. If you look in your control panel, folks, down near the bottom, you'll find handouts listed, and all you have to do is open up that portion of the panel and then click on either one of the two handouts. They're exactly the same as far as content's concerned. One of the lines deals with slides 1 per page, and the other line deals with slides 4 per page. But you can click that on and move that right into your desktop, and then you can print that at your leisure. Cy, we want to thank you so much for what you've done for us today. You're getting all kinds of kudos through the questions box here, and we want to add our thanks to that as well. I also want to thank our folks in the back room for helping out, and we hope we see a lot of you continuing on to our next and last session, which will begin at 3 p.m. Eastern Time, and that's going to be an old-fashioned Let's Talk Stock panel. See you then, everybody. Thanks for coming.